Hello friends, this is lesson number 18 of the Options Are Easy series. Let me remind you that in this series I'll explain trading with stock options. And today we're going to talk about very interesting option strategy, diagonal spread. In the last lesson we looked at the calendar spread. Before that there was the vertical spread. And in the comments under the video about the calendar spread, one of my subscribers asked, why is this even a spread? It looks more like a butterfly. Answer. We trade with price spreads between the financial instruments. That's why it's spread. For example, in a vertical spread, we buy the near strike of an option and sell the far strike. Therefore, we get the spread between the options. In the calendar spread strategy, we get the spread between a series of options of the same strike. So, what is a diagonal spread? A diagonal spread is a combination of a vertical spread and a calendar spread. We work with the near series of options and the far series, as well as the spread between the strikes. Let's build such a spread in the AE desktop terminal. I can do it in the option chart builder. And let's add a close call option of the center strike, for example 26. Expiration is very soon. I sell 1,000 contracts, that's 1 Bitcoin. The next strike, for example 28, expires more than a week later. I buy 1,000 contracts, and now look at the spread. If I had chosen 26,500, I would have reduced my risk level. Now, let's give it a try. A couple minutes, I'll change the data. And now we've got another diagonal spread. As you can see, this chart is very different from the calendar spread. To recap, I sold a Bitcoin options at the center strike of 26K of the nearest expiration date and bought the same amount of the next strike, 26,500, the next expiration date. Now I'm going to zoom in on this chart and tell you about its characteristics. On the left side, I have the no-loss zone. If the Bitcoin price falls, I won't take a loss. Notice this chart here is the chart of the nearest expiry series. The chart is extremely changeable and depends on the price of the long-distance options. And the price of the long-distance options depends on the IV. But we can't know what the IV will be at the time of expiration of the near-term options. So this chart is easily changeable. Soon I will show you a simple example and you will see it for yourself. If the volatility of the far option rises, watch how much the chart changes. Thus we get more potential profit if the volatility of the long series rises. I think you've understood everything, but at home you can play with the volatility yourself and see how the chart changes from it. AE Web Terminal, AE Desktop Terminal will give you all the tools for this, and you can use it for free. So if the Bitcoin price does not change before the expiration of the close series and remains under this cap, then we make a profit. The margin requirements of this strategy are equal to the maximum loss, $523 in this case. As a reminder, click the GM button to recalculate margin requirements after changes. The profit potential in this spread is small. You can make about $150 or $200. So what happens when the price rises? We take a loss. This strategy should be used when we do not expect the Bitcoin price to rise significantly. That's all I can tell you about the diagonal call option spread. We'll look at the inverse diagonal spread sometime later. For now, I suggest we see what happens if we choose long-distance series, such as quarterly series, instead of short-distance series. For example, let's add call options of strike 27, 1,000 contracts to the strategy. Just to remind you, the T price button changes the open price value to the theoretical price. Since the long-distance options are more expensive, our construction become lower. We have lost the no-loss zone. Theta is positive and time decay works for us. But if the price moves, we could suffer a loss. If Bitcoin falls, the risk is limited to $170, but if it rises, we can lose about $1,000. Now let's look at the inverse diagonal spread. To construct an inverse diagonal spread, we must sell the far series of options and buy the near series. We get the mirrored image. At low volatility levels, the diagonal spread looks more interesting. If we were to use a calendar spread, we would have the symmetrical strategy wings, but with a diagonal spread, they are different. On the left is a small profit, and on the right is a big profit. Now I propose to build an inverse diagonal spread but with put options. To do this, we need to buy the near put options of the center strike 26 and sell the next strike 25 with the late expiration date, the same amount. As a result, we have this strategy, whereas with call options, we constructed a diagonal spread expecting significant upward move, but with put options, we expect aggressive downward move. The margin requirements are $537. If the Bitcoin falls to strike 22, for example, our profit will exceed $1,000. If the price rises, we will make a small profit of $130. You can see it there. But it is important that the price leaves the area of the purchased strike. The risk starts when the price stays at the current level. How to limit the risk? You just need to set a stop loss. If the price doesn't change and the time decay eats into your profit, then you need to close that position immediately. I have already made a video about risk limitation. Watch it if you missed it. Figure out for yourself what maximum risk you're willing to take. Maybe it's $100, maybe it's $50. But if you need a no-loss zone, you can sell the options of the farthest strike and buy a closer series. How do you pick the date of options to buy? If you have a certain price scenario in your head and you expect a price change to happen in a certain time period, there are dates you choose. First one when it starts, the second when it ends. Homework. Model a diagonal spread with Ethereum or Dogecoin, and also model an inverse diagonal spread with put options and call options. Just try it, and then you'll have a powerful tool to capture the price movement. And if the price movement happens in the other direction, you will still make money, but a little less. If the video was useful and interesting for you, please like it. Subscribe to the channel about trading with stock options. I think you will not find more detailed information about it anywhere else. I wish you all the best and successful options trading.